Hey folks, Dan Frio here with some special breaking news from the Fed. The PCE, the number one inflation number that the Federal Reserve monitors, it just came out this morning. How did it do? What did it come in at? And where did mortgage rates go from there? Well, that's what we're going to talk about in today's video. So my name is Dan Frio. I do these videos twice a day to inform you guys what the heck's going on with these things, especially real estate. We do talk about equities, but just in relation to how they're affecting mortgage rates. So without further ado, let's get to the breaking news from Rick Santelli, because we had futures are lower after a U.S. hot inflation report. So let's get over to Rick Santelli so he can give us the news. Rick, take it away, buddy.
Well, you know, there's a lot of big numbers in the rearview mirror on spending and income that were really shocking last month. So we want to see if we reverse some of these trends. And it's hitting the wires, Joe. February income, spending, and PCE. Expecting the income number to be up about 0.5%, maybe up 0.4, double that, up 0.8. And up to now, no revisions yet. That follows up 0.9. You know, up 0.9 last month was 1 year high. Let's add in 0.8. This is solid back to back. Now, if we look at the spending side, last month at -0.2, that was the first negative number in 2 years. It was the biggest negative in drop in spending in 4 years, but we reversed it to some extent, up 0.4, about as expected. And if we look at real spending adjusted for inflation, last month, -0.5%. That was the first negative in a year, the biggest drop in 4 years, but yet we reversed that, but in a smaller way, adjusted for inflation, up 0.1. And now let's take a look at the PCEs. We'll start out month over month, expected to be up 0.3, comes out at 0.3. If you look at year over year, expected 2.5, it comes out at 2.5. If we look at the core now on a month over month, expected up 0.3, a little warmer, up 0.4. That would be the warmest going back to, well, I'm going to have to go. That'll be the warmest basically in a year, January of 24. And finally, if we look at core, year over year, expected 2.7. It's a 10th warmer as well, 2.8. 2.8 will be the warmest going back to, well, the end of last year, we were 2.86. So this one remains sticky. Revisions coming in now. Okay, I'm going to go slowly here. The income goes from 0.9 up to 0.7 last month. The -0.2 on spending gets a little bigger, -0.3, but we reversed it. And -0.5% on the real spending number goes to -0.6. So we see that some of the takeaways from revisions were a little bit less on the positives, a little bit more on the negatives. But all in all, I think it's a pretty good report. Now, even though we had some slightly hotter PCE numbers, we see that yields are moving down. Now, 10-year yesterday had a 1 month high close going back to the 24th of February. Here we are right now hovering at 431. At 431, we're -5 basis points on the day, but we're still up 6 basis points on the week, and that's something to pay attention to, especially considering the steepening of the curve we're finally starting to see. We're back about 35 basis points, 10s to 2s. Joe, Becky, back to you.
So if you're completely confused on what he said, let's get over to the economic calendar. Here's basically what he just went over. So he went over the PCE, the number one inflation report that the Federal Reserve monitors. Now, this is a head scratcher because it came in higher than expected. And every time we've come in, you know, even a 10th higher than expected, the markets just get hammered. But if we go over to the MBS market right now, it's actually looking not so bad. We have the MBS is up 10 ticks. And if you've, normal watcher of this channel, we know when this goes up, mortgage rates come down. So what actually is happening behind the scenes? Well, there's a very interesting interview yesterday or last night with BlackRock's CEO, and I want to show this to you. I usually don't show 2 videos in one clip, but this is really important because we're trying to figure out, okay, why are people moving out of the stock market into bonds? Are they truly doing that? Are they parking their money on the sidelines? Where's all the money going? Because we've had deterioration in the stock market as well as deterioration in the bond market. Where's this money going? So there was a fantastic interview that I saw last night with BlackRock's CEO. Watch this interview, and it's very important because it ties a lot of the stuff that I've been teaching you guys. You know, people moving their money to safety, why people are maybe moving into bonds instead of the equity markets, helping, interest rates and the bond market. let's watch this video because it's really important for you guys to understand how all this works with the equity markets, the bond market, corporate bonds, yields, and everything else. This young man's going to go over it with you, and I think you're going to learn a lot of information from this interview. And I might stop it periodically or give you some points like this to pay attention to. So let's get over to why the markets are doing what they're doing. And the interview thing right through here is he said the markets went from animal spirits to animals in hibernation. Basically, everybody was piling on into the stock market right after the election last year. And all of a sudden, the markets are deteriorating. People are pulling their money out, and where's it going? So let's listen to this interview. Very intriguing.
Suggesting don't wait around. Like they're already switching their allocation mix. Way heavier in bonds, for example, and lighter in equities. And you've had many firms take down their exposure, take down their outlooks. You get Barclays today, markets are underpricing trade risks, switch preference to global fixed income over equities. I mean, this is your wheelhouse here.
So there's something really interesting, and this is a pretty historic point in time. Normally, you think about, gosh, I got to go to cash. I got to get really defensive. The beautiful thing today is you've got a central bank, you've got the Fed, and by the way, the ECB, that hasn't hit its inflation target. So you keep the front end of the yield curve high. What that allows you to do, you can build a portfolio with pretty safe fixed income, create 6.5, almost 7% yield. And so think about what that means.
I broke what he just said. Think about what that means, and that's what he just said. If you take your money out of stocks, you can actually put it into a bond portfolio and make 5, 6, maybe 7% yield. Very rarely in history could you have done that with the bond market, other than years and years and decades ago. So that's why a lot of people are just saying, you know what, with these yields, I'll take some risk off the table and move it over to bonds because I can get a 6% yield with really no risk at all. And that's what a lot of people are doing. So let's go back to what he's saying. He breaks all this down for you in basically easy to understand a situation.
Means if you're on a pension fund, an endowment, foundation, my return target, by and large, is around 7%. And inflation, let's say inflation's running high 2s. We could debate which metric we use. Gosh, if I can hit 7, I've got operating income I've got to manage. Inflation, that gets me a pretty attractive real rate relative to anything we've had over the last couple of decades. So we are seeing some of that shift. And I think it's real. And I think you'll continue to see that income. And by the way, it's also a historic point in time because post-COVID, companies, consumers, financial institutions delevered because rates were so low, so they've termed their debt out. So you've got actually a structurally good time to invest in these asset classes. So it's a pretty neat. So you are seeing some of that shift. By the way, I don't think it necessarily means if you've got a lens longer than a week, a month, 2 months, you should get out of equities. I think there's some great stocks, a bunch of which have been repriced down. I just think you got to manage your near-term beta a little bit and then think about, gosh, what are the stocks I'm going to hold, and I'm going to hold them for a longer period of time.
Like what kinds of stocks? If you can't talk about individual names, like I know you probably don't want to, but when you say that, what are you referencing?
So listen, I think at the end of the day, you've got to take, so technology is a great place to invest in equities. But you think about today, you talked about AI. By the way, I think it's extraordinary where we were a month ago or 2 months ago, because markets can only do one thing at a time. And then all of a sudden the sentiment changes. But I think you broaden out how you think about it. Who are the companies that utilize data effectively that are maybe broader than the mega cap? And so look at some of those companies. The healthcare companies, I think, are super interesting around where you're using data effectively. Financials, I think, by the way, not just US, Europe. I know they've had a great run into some of these European financials, some of the European banks. But you look at the multiples on those banks. If you believe that Europe's got some infrastructure spend, some of those multiples, even with the rally, are still pretty attractive. So I love the idea of doing that. And also for the first time in years, diversify a bit more internationally. That, by the way, including Asia, where there's some opportunities. It's just as I think the U.S. is going to be a little bit more uncertain than we've been used to. And, for the first time, U.S. economy, we could have a transition that administration's comfortable with because we got to bring the debt down and we got to do a number of things in the country that maybe we can just transition a little bit. Maybe I can hide a little bit internationally while that plays out.
So we'll leave it at that. But you understood what he was saying. He said you could get basically bond yields. You can get yield on your money. It's 5, 6, 7% in bonds with basically no risk. So a lot of people in the past, you weren't able to do that. So you either had to be in the stock market or you had to be in cash. Right now, people are going back and forth. And that's why, it's an anomaly right now that the inflation report came in higher than expected. And we have the MBS markets, mortgage bonds actually up a little bit, meaning mortgage rates, well, this isn't really going to do anything to the markets. But it's just an anomaly today. And I'm trying to figure out why. And hopefully this is kind of helping us understand a little bit more. The main inflation numbers that we have with the numbers that came in today, when you look at the PCE year over year and month over month on the normal PCE, came in right at point. But on the core, that strips out food and energy a little bit hotter than expected. So as soon as these numbers came out today, I'm like, that's not good news. And then I go over to this and I'm like, okay, it's the MBS market is, I'll say, flat. I thought this would completely deteriorate as well as the stock market. So we're going to continue to monitor this throughout the day because any little hiccup can cause all this to move. So let's get over and recap some of the data that we have right now. So yesterday, mortgage rates went up just a little bit. Today, so far this morning, the PCE, the number one inflation number that the Federal Reserve monitors, it came in a little bit hotter than expected. We got red all the way across the board. Good thing is we got oil down. We got the 10-year Treasury right over my head. It's down as well. Let's see what cryptocurrency is doing just for kicks. It's down 1,800. This thing's like a yo-yo. Okay, we got the bond market right through here. The MBS is up 11. We're going to track that throughout the day. I think we're going to stay in this tight range right now until basically the markets figure this piece out. The economic calendar, like I said, we just went over basically everything that there was to cover today on the PCE. That was the biggest event for this week. We go over to it, and here's what the Federal Reserve monitors, the economy at a glance. We go over this at least a couple times a week, and the reason why is we filled in a lot of these blanks this week. Okay, if we have the federal funds rate right through here, is it expected to move? Well, let's check that out. Let's go to the CME FedWatch tool. In 40 days, the Federal Reserve is going to do something. What are they going to do? Well, there's basically a 90% chance they're going to do nothing because of this. So let's go over to this. So what filled in this week or last week? Well, this filled in today, the PCE, that will be updated. Unemployment rate, that was filled in last week or the week before, I want to say, and that ticked actually down one tick. And then we have GDP coming in, and that's actually on point as well. So pretty healthy economy through here. The markets are just skittish because they don't know what tariffs, immigration, the wars, and all economic world events are going to happen. So we're going to just have to continue to monitor those things. So that's basically the report for this morning. I think we dodged a bullet. We'll continue to monitor this for today. But right now, mortgage rates are flat. I'm going to come back at the closing bell to let you know how all this mess ends for the day. But first off, let's get over to me, who I am, what do I do? What's that one application, one credit pool? We're going to shop your loan to over 30 different lenders. Well, before we go there, and before you put in an application anywhere, either for a mortgage or a car, please go to optoutprescreener.com. What this does is it stops your financial data from being sold to other institutions. So what happens is when somebody pulls your credit for a car or a home loan, the credit agencies are selling that data. If you want to stop it, go to right through here, optoutprescreener.com. The credit agencies made this, and it's actually a free service to sign up. So please make sure you do that. You'll thank me afterwards. So now on to me. My name is Dan Frio. Like I said, go to the rateupdate.com. You'll find more about me and my team. But here's what we do here. I'm actually a federal loan officer, and I've been doing this for over 35 years. I'd love to help you. I'm licensed in all 50 states as well as Puerto Rico, so there's no reason out there you couldn't use me. Now you're probably saying, Dan, do you have the programs? Do you have the rates? Well, let me explain to you what I do. We're a federal bank, but we're also set up with 33 other lenders right now. So what that means to you is you're going to be able to get with me, and I'll be able to get you quotes from 30 different lenders. Now, we're a broker and a federal bank. So we're not like a clearinghouse where I get your data and sell it off. You'll work with me the entire time through the process of application, the keys in your hand, or if you're looking to refinance, maybe your application to skipping that mortgage payment and saving a bunch of money each month. So if you want to check out how I can help you out and the services we offer, go to the rateupdate.com. Here's my website. You can reach out to me 4 different ways. One, you can put in the application right up through there. You can schedule a consultation with me right up through there, or you can call me or email me right at the bottom, down through the bottom of the website. So it's 844-775-5626, or you can reach me personally at dan@therateupdate.com. If you have a comment, please leave that down below. If you have a question, you really need my help, put it in here, add in your phone number or however you want me to contact you. I'll be happy to call you, go over that question, any other questions that you have. So I hope you understood what we were talking about today. The bond market or inflation was a little bit hotter than expected, but the bond market's not reacting like we thought it would be. And the reason why is I think a lot of people are moving to safety. So thanks for watching. I hope you learned something today. God bless. Have a fantastic afternoon, and I'll see you here at the closing bell. Take care. See you then. Bye-bye.